no accounting entries have been made in respect of the deferred cash consideration. 𝐎𝐿𝐒 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐒 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐒 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for three companies, 𝐿𝐒, Pepper, and 𝐶𝐶𝑠. We have the statement of financial position for the three companies, that is 𝐿𝐒, Pepper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? At A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐒 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Pepper, a public limited company on 1st April 2024. So the company which is called 𝐿𝐒 Limited, this company acquired 80% equity shareholding in a company which is called Pepper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐒 is the parent and then Pepper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐒 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐒 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAT. What does that mean? It means that on the dates to compensate the insurer on the happening of a contingency, or basically on the happening of a future uncertain event, and now the insured on his part basically commit himself to be paying some periodical payments which are known as what? The premiums, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event, and this person on his part must be paying some periodical payments which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have the life insurance, and when we talk about the life insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age, or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, insurance or the life assurance. And therefore, the general insurance, this includes insurance businesses such as burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what you call the general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number 1, we have the revenue account. Number 2, we have the general statement of a profit or loss, or basically the income statement. And number 3, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. Assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? To determine the financial performance of each insurance business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company basically undertake two insurance business, maybe like the fire insurance, or provide two insurance business, the fire insurance, and maybe